Ladies and gentlemen, today I invite you to walk with me through the story of Conduent Incorporated, a company at the intersection of business process services, technology and transformation, and to explore how, despite headwinds, it is charting a path of operational improvement, strategic repositioning, and future potential. When Conduent reported its third quarter of 2025 results, the headlines were mixed. On the one hand, revenue for the period came in at $767 million, down from $807 million in the same quarter last year. Conduent, the adjusted revenue figure, likewise at $767 million, was down about 1.8% year-over-year when excluding certain items. Conduent, earnings on a GAAP basis were a loss of approximately $46 million, compared with a profit a year earlier. Investing.com. So at first glance, the top line is shrinking, the bottom line negative, not encouraging. Yet, and this is where the nuance lies, the company also reported adjusted EBITDA of $40 million, with an adjusted EBITDA margin of 5.2%, up from 4.1% a year earlier. Conduent, in other words, although revenue is challenged, the company is improving its operational efficiency and moving the margin needle upward. Furthermore, Conduent completed a refinancing of its revolving credit facility, extended maturities, paid off a prior term loan, actions that strengthen its financial flexibility. Conduent, it also announced notable contract wins. For example, a toll collection pay-by-plate system awarded by the Richmond Metropolitan Transportation Authority in Virginia, and expansion of its Philippines operations to support customer experience management for a U.S. healthcare company. Conduent. What does this all mean? Let's unpack three broad themes: challenge, transformation, and opportunity. 1. The challenge. Conduent's shrinking revenue is a clear red flag. The decline reflects a business environment where large contracts may be slower to roll out, competition is intense, and legacy models are under pressure. For example, its commercial segment and government segment both showed declines in revenue year-over-year, though the transportation segment saw growth. Investing.com Canada, moreover, free cash flow turned negative, $54 million in the quarter, despite margin improvements, reflecting that converting profits into cash remains an issue. Conduent. This suggests the company is still in transition, it is not yet out of the woods. 2. The transformation. Here is where the story gets more hopeful. Conduent is revising its operating model, focusing on advanced technologies, artificial intelligence, automation, analytics, to drive higher efficiency, fewer manual processes, and better outcomes for clients. The company's commentary emphasized Gen AI integration across document processing, fraud prevention, and customer experience systems. Conduent. It is also reducing complexity via divestitures and rationalizing its capital allocation. It has achieved 87% of a $1 billion capital allocation target to date, per management commentary. Conduent, in essence. Conduent is trying to shift from a low-margin, volume-based business toward a higher-tech, value-driven business. That shift takes time, and often shows up first in margin improvement rather than revenue growth. 3. The opportunity. Conduent's guidance offers a window into management's view of what comes next. For full year 2025, it guided adjusted revenue of between $3.05 billion and $3.10 billion, and an adjusted EBITDA margin of 5.0%-5.5%. Rolling out, that margin target may appear modest, but given where the margin was, it reflects a meaningful step. Moreover, certain segments, notably transportation, are showing tangible growth. The growth in contracts and pipeline, for example, new business signings ACV of $111 million in Q3, signal that the engine is running, even if the load has not fully arrived. Conduent. For investors, the opportunity lies in whether Conduent can convert these operational improvements into sustainable growth, improved cash flows, and ultimately, meaningful earnings. If the company succeeds, the margin improvements today could be the foundation for revenue inflection tomorrow. In closing, the story of Conduent is not a straight success story. It's a story of facing headwinds, of necessary transformation, and of cautious recovery. The shrinking revenue is real and must be addressed. But the margin improvement, the strategic tech focus, the debt refinancing, all are positive signals. If I may, I'll leave you with 3 questions to consider. Can Conduent accelerate revenue growth in its key segments and win more contracts in faster cycles? Will the shift to higher tech, higher value services pay off with scalable margins and stronger cash flows? And finally, As it executes its strategy, will the market recognize the turnaround and price in the potential? The work is ongoing. The pieces are in motion. And how the next several quarters play out will be critical for Conduent's future. Thank you.